Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with my good friend Brian. And in today's video, we're discussing how annuities are taxed.
Great. This is an important topic,
Yeah.
Michelle, because exactly how much you pay in taxes is based on the type of annuity and how the account is set up in the beginning.
And that's
So,
big.
really, you need to understand the type of annuity and its tax implications before you sign on the dotted line, and it's critical to your financial future. So,
Yeah, I know a few people who have ended up taking a pretty heavy tax hit because of this and paying way more than they originally planned. And I mean, it's never fun, but it also really puts a wrench in retirement savings or just your overall financial health, right?
right, right. It's not fun, but it happens all the time. The thing to understand is that annuities are taxed like any other retirement plan. Okay.
Mhm.
And all annuities, no matter what type, grow tax deferred, meaning that you don't pay any taxes until you take a distribution or an income payment
Mhm.
or making a cash withdrawal. So
Okay.
when you make a withdrawal, Michelle, or you cash out your account, it's taxed as normal income, not at a favorable capital gains rate. Big difference there.
Yeah, huge difference.
Uh, as I mentioned just a minute ago, exactly how much you pay is based on the type of annuity and how the account is set up in the beginning. Very
Right.
important. And there's two main annuity taxation categories: qualified and non-qualified.
Okay.
And understanding which one you have will make a big difference come tax time.
Absolutely. All right. So before we dive into the details, if you like the content of this video, hit that like button and don't forget to subscribe. Also, we're going to drop in some of our top annuity videos below in the description. So make sure after you finish this to check those out. All right, Brian, let's start with qualified annuities. Define that and explain how they work tax-wise.
Okay, let's start with, annuities are like a retirement plan. A
Right.
qualified annuity is funded with pre-tax dollars. Okay, kind of like an IRA, right?
Yep.
This means you pay taxes as normal income in the year that you take a distribution or you cash it out. Very similar
Very
to the
similar.
IRA.
IRA.
You
Yep.
got it. So let's say, for example, you take $20,000 withdrawal. $20,000 will be added to your taxable income in the year that you have that funds distributed to you, since no taxes have ever been paid on this money prior to this date.
Got it. Okay.
Let's say you make a 60,000 withdrawal this year and you just decide, you make 60,000 this year and you decide to take a one-time withdrawal or you cash out your annuity. That means that $20,000 that you took out of your annuity is now added to your $60,000 of income.
And
Now
you
you're going to
pay
be taxed on
80,000.
80,000 of earned income when you pay taxes in April. We have to remember this, okay? Because this is an IRA, the IRS will also charge you a 10% penalty on any funds that you take out prior to the age of 59 and a half. A Roth IRA, even though it's funded with after-tax dollars, is also considered a qualified annuity
Okay.
because it falls under the IRS tax guidelines for premature withdrawal, penalties and taxes if you're under the age of 59 and a half. So we have to
Okay.
remember this. Very
All
important.
right. That's huge.
Yes.
There's a big difference if you jump up to the $80,000 a year tax bracket
Or higher, or higher even.
or higher, right? Yeah. Okay. All right. So let's talk about non-qualified annuities.
Okay. Non-qualified annuity, Michelle, think of it like cash. Okay. You've paid for or you're funded with after-tax dollars. You've already got your paycheck. This is money that's sitting in the bank. But they're taxed a little bit different than qualified annuities because you're only taxed on the gains or the earnings since the contributions were already taxed. Okay.
Okay.
A little bit different. Not the whole amount when it comes out, just the earnings is taxed.
Sure.
Okay. So your money grows tax deferred until you make a withdrawal, whether it be withdrawing regular payments, one-time withdrawal, or cashing out the whole
Sure.
annuity. Okay.
Okay.
Doesn't matter. So to figure out the gains and determine how much is taxed, we use what's called an exclusion ratio to
Okay.
figure out how much your payment, whether an income payment or a one-time cash payment distribution, is taxable and how much is not taxable. Okay.
Okay. Got it.
Basic. Oh, go ahead.
No, go ahead. I
Oh,
just said got
oh,
it. Yep.
okay. Basically, an exclusion ratio is the difference between your earnings and the amount of your principal paid. And
Okay.
here's how it works. Let's say your principal payment into this non-qualified annuity, which was with your after-tax dollars, is $100,000.
Okay.
You let it grow tax deferred for 10 years, and now it's worth 150. Okay. Your gains in the account are $50,000.
All right.
Now, okay. So now let's say you want to take out 75,000 for a down payment on a home or to make a very large purchase, buy a car. I mean, 75,000 barely buys a car today. Some of
Right.
them.
What car are you buying? No, I'm just kidding.
But many people don't realize that IRS mandates that you take your interest out first.
So interest comes
You have
out
to remember
first.
this. Yes. Last in, first out. Many annuity holders just think, oh, I'll take out 75,000 my principal and never
Sure.
touch my 50,000 in gains. IRS says, no, no, no. You can take out your 75,000, but the first 50,000, which
Comes
is your
off the
gains or your
gains.
interest, we're going to tax that first. So
Sure.
you got to remember it. Last in, first out, LIFO. Okay.
Okay.
So the IRS is going to charge you first on your gains of 50,000, which now becomes taxable income on the year that you withdraw it.
Right. Okay.
The additional 75,000 from the principal is not taxed because it was already taxed once.
So the initial the additional 25,000 is okay of the 75 because that's
Of the
principal.
75. Yeah.
Okay.
So all you get taxed is the earnings. So here's what's going to happen at the end of the year. You're going to get a 1099 from the annuity company showing a distribution of 75,000 from your account because that's what came out of the account, right? Right below it in that 1099, I think it's either box 2 or box 4, depending on, they keep changing them all the time. You'll see a taxable portion of that amount of the 75,000, which shows 50,000. That's what you're going to pay taxes on, the 50,000.
Okay. All right. So to recap, the non-qualified annuities are only taxed on the gains since the earnings or the, gains because
or earnings.
Or earnings, right? Since the contributions were already taxed. And with qualified annuities, you're going to pay taxes as normal income in the year that you take it out or you cash it out. You just
correct. The whole amount is taxed as normal income there. So,
so I'm going to go back to something you said at the very beginning of the video. It's really important that you understand the annuity type of annuity before you set it up, because once you set it up, the tax game, whatever the play, it's already in place. There's no going back.
Right. You can't go back once it's set up. So
read those contracts, understand the difference.
Watch these videos.
Absolutely. Yes. All right. On that note, if you like the content of this video, we'd appreciate the like. Help us grow this channel, please. And then also don't forget to subscribe and do check those videos out below. We have some of our top annuity videos. Definitely. And that's all we got. Thank you, Brian. And thank you everybody who watched.
Thanks, everyone. Thanks, everyone. Thanks, Michelle. Have a great day.